In this month's economic update, Kaplan Professional Education's Michael Pollock speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly economic update. I'm Michael Pollock, and this month we're speaking to independent commentator and columnist for The Australian, Don Stammer. Thanks for joining us today, Don.
Thank you, Michael. It's good to be here.
Let's firstly look at the Australian economy, Don. Given the persistently low inflation numbers, what's the likelihood of a further interest rate cut to 1.25% at the RBA's November meeting?
Certainly the financial markets are expecting another rate cut and maybe 2 rate cuts over the next 15 months. My guess is it's not as simple as that. Certainly the Reserve Bank has to look at what's happening to inflation, and that's below its target. But its target, of course, is over the course of the economic cycle. Jobs growth in Australia is fairly good, unemployment's down, though underemployment's still very high. The Reserve Bank might have thought of cutting interest rates to get the Australian dollar lower, but if you look at what's happened in Japan and New Zealand, recent cuts in the cash rate in those countries haven't brought their currencies down. Also, there's housing. The Reserve Bank made the comment last time it cut interest rates that the pressures in the housing sector seem to be easing. I know a lot of people in Sydney and Melbourne that can see no signs of that, and the Reserve Bank would be quite incorrect for them to push housing prices higher. So on balance, I would say that the chance of another interest rate cut is less than the market's probably anticipating.
A large increase in the supply of apartments in the eastern capitals is scheduled for the next couple of years. What impact do you think this will have on the metropolitan housing markets overall?
I think we have to make a distinction between city-wide problems and problems in particular spots in the cities. Certainly some parts of Sydney, Melbourne, Brisbane and Perth also have an oversupply of apartments, and that will build up worse. As that happens, I think you'll see some people who've put deposits down walk away, and there'll be some builders who fail as a result of that. Also, rents will come down. But I see these as very much problems for specific locations, not for the citywide and not for the nation.
And finally, what will be the main drivers of the Australian economy for the remainder of 2016 and into 2017?
The strongest parts of the Australian economy will be health and education spending, both by government and by households. Also, there's a lot of infrastructure spending now starting to come through, particularly, though not only, in New South Wales. There'll be a little bit of good news for iron ore exporters. The price has picked up quite a bit from the lows last February, and that will help incomes nationally. The weakest part of the economy, of course, will be mining capital spending. That's now fallen from 8% of GDP to 2.5% of GDP, but we're not quite at the bottom yet. So overall, I'd guess the Australian economy will continue to have growth of 2.5% to 3%. That's probably just a little above trend.
Turning to the US, economic data is something of a mixed bag at the moment, with positive labour market indicators, but ISM data showing a decline in economic conditions. What's your view on the timing of another rate hike by the Fed?
My guess is the US Fed will raise its rates in December, provided international financial systems are not particularly stressed. But that would only take the US cash rate to between 0.5% and 0.75%. I'd also expect another one increase in the course of 2016, but even then the US cash rate will only be between 0.75% and 1%. So it's a very drawn out, gradual and phased in set of tightenings in the US on the cash rate.
So what will be the main drivers of the US economy for the rest of this year and into early 2017?
The main driver in the US, unlike Australia, is household spending. The Americans are good at spending and they're recapturing the skills of the past. The weakest part of the US economy probably will be exports and business capital spending, but the US economy will get a boost in the next 6 months from the ending of the big rundown in inventories that's been a feature of the first half of 2016. So overall, I think the American economy will grow at 2.5%, and given the phenomenal drop in productivity growth in America, productivity growth has actually been negative of late, even growth of 2.5% in GDP will create a lot more jobs.
Looking at China, what future do you see in terms of the transition from a production-based economy to one driven by consumption and services?
I think China's progress will continue to be on the better side of muddle through. China's got some very big tasks to perform. It's trying to rebalance its economy away from heavy capital spending towards consumer spending and particularly towards services. China's not as good as it should be in achieving that rebalancing, but if you look around the world, there are a lot of other countries trying to rebalance their economies and also finding it difficult. But my guess is China has avoided the recession that people feared a lot in January, February. China's trend growth is slowing, and every year that they have a good year, it's harder to keep the trend growth as high as it has been. But I do think China will surprise people with its ability to develop consumer spending. And in fact, retail sales have been increasing at double-digit rates in China, and China will impress people with the growth of its service industries.
So which sectors of the Chinese economy do you think will outperform going into 2017?
The two sectors I think will outperform most will continue to be household spending, and that rate could continue close to double digits for the next 2 or 3 years, rate of increase. The other one that will increase a lot, I think, is services, particularly services to do with IT, services to do with domestic travel, and of course a huge growth in Chinese holidaying overseas. The part of the Chinese economy that won't do spectacularly well is heavy iron and steel production, but it will be doing less badly than people thought a few months ago.
And finally to Europe, with inflation well below the target range, how likely is it that the ECB will extend the current QE program beyond the planned March 2017 expiry?
There's quite a rethinking going on within the European Central Bank about the QE program. Germany was never in favour of it, but I do think they'll extend the duration of the program, but I don't think they'll do what markets have been hoping until recently, and that is increase the amount of the bonds that they purchase each month. Certainly they'll have to extend the range of securities the European central banks can buy, because there aren't enough conventional bonds still available. So I think overall Europe will move very cautiously on the quantitative easing. I think Europe also shows that negative interest rates have been an absolute disaster. They've made it very difficult for European banks, not only to borrow and to lend, but also to build up their capital bases. So there'll be, I think, modifications and moderation of European special monetary policies.
What do you expect to be the main economic impacts for the EU if Britain does actually trigger a Brexit?
I think Britain now has to leave the common market, and the common market partners that Britain's had for many years are saying get out, because they don't want Britain to be able to put its own policy on immigration. If Britain leaves Brexit, and I think that's inevitable, it will have quite a significant effect for Britain, certainly help its public finances, because Britain taxpayers do put a lot of money into the policies that benefit continental Europe and not particularly the southern nations in Europe. But also if Britain pulls out, Britain will still have to put a lot of effort into making sure that London remains a world financial market. I think it'll be able to achieve that because the London markets have got a long history, and the Europeans have tried it many times to try to knock off the prominence of London as a financial market without a lot of success. It'll also mean that the British economy is less regulated because they'll be able to escape. But nonetheless, it'll be a bit of a negative for Britain as well, and it's very important Britain handle it and looks at the options and really puts a huge effort into achieving the best possible outcome.
Thanks very much for your time today, Don.
My pleasure, Michael.